Hello, today I'll be providing a recap of our recent seminar relating to 2021 and 2022 tax changes and planning strategies. Thank you for attending today. Today we'll look at basic tax bracket changes, inflation adjustments, and some expiring tax credits. We'll also look at some of the Social Security and Medicare premium changes, as well as Biden's tax and spending proposals and how that may impact your future taxes, and then some general tax planning strategies. As you can see, currently brackets have not changed. They've had a major revamp in 2017 to 2018 where rates changed. And as you can see on the left-hand column, we represent the 2017 rates. And then on the right-hand column, we represent the current 2021 tax rates. Take note of these brackets because it's very important when it comes to tax planning strategies. Generally speaking, the lower the tax bracket you have, the better, and there's various strategies among each tax brackets. For 2021 standard deductions and itemized deductions, you have to be aware of where the brackets lie and what's available to you. For single filers, the standard deduction is $12,550. But for those 65 and older or blind, you get an additional amount to the standard deduction. Please note this because various strategies hinge on whether you itemize or take the standard deduction. One important thing to note is charitable donations maintain 100% of adjusted gross income, the deductibility on them. Some temporary provisions and tax credits as they relate to COVID. The CARES Act provided above the line deductions for those who are standard deduction filers and give charitable donations. For a single filer, you're eligible to take $300 of a deduction above the line as long as you give $300 to charity or more, but it's capped at $300. And $600 for joint filers. Flexible spending accounts, it used to be use it or lose it, but temporarily they've extended the use of any unused balance can get rolled forward. The American Rescue Plan, most people received economic impact payments of $1,400, and they've made some adjustments to the child tax credit. If, however, you have not received some of the payments noted on the slide, you will reconcile through your tax filing to receive the additional benefit. Your tax bracket determines your Medicare premium each year. So the tax return that you filed in 2020 provides the premium that you pay on the 2022 Medicare premium. As you can see, up to $182,000 of adjusted gross income is where the bracket is for the standard Medicare Part B premium. And then for Part D, it would be your general plan premium. One thing to take note is you could have a perfect tax planning strategy, but then be completely unaware of how your Medicare premiums may change. So make sure you're not adding additional income that puts you into a higher Medicare premium bracket. One thing to note is the 2022 premiums have not yet been released, so these are just estimated premiums. In general, the base Medicare Part B premium will increase by about $10. Most of these premium rates will follow the 5.9% expected cost of living adjustment to Social Security. So now we're going to look at a little bit of the past, so it helps us look to the future. What this chart represents is the highest tax rates and the lowest tax rates over time. The red line is the highest tax rates, and the green line is the lowest tax rates. So what you can see is we've sort of had bracket compression over the years. So where the lowest rate and the highest rate are closer than what they have historically been. What we see over the last 40 years has been that revenues, for the most part, are under outlays, which means we spend more than we make. In this case, revenues are tax revenues, and outlays are general government spending. So what we need to recognize is that at some point, tax rates may have to increase to compensate for the outlays, or you have to cut spending in one way or another. So we have the blue for outlay and green for revenue. So keep this in mind as we go to the next slide. So you can see on this slide, there's a lot of information. It might be helpful if you take time just to look at what's being represented here and read the different bullet points. But in general, you have the blue circle, which is outlays, and the green circle, which is revenue. And this is based on the federal budget for fiscal year 2020. As you can see, outlays or spending is higher than revenue. So what we're looking to do through the 2022 budget proposal would be to generally balance the budget so that revenues and outlays equal each other. So we've heard a lot of talk lately about these spending proposals and various packages that Congress is looking to put together. So here is a breakdown of the most recent 2022 budget proposal. I will make note that this is changing every day. So understand that if anything does pass, it can be completely different from what we've presented here. What we've tried to take in the next couple of slides is the most prominent ideas that have been presented in proposals, whether they're tax rate changes or whatnot, and boil them down to a couple of slides. So one of the major tax proposals has been restructuring corporate tax rates. They've talked about having a graduated corporate tax rate that started low and then went higher, but it seems that they're looking for this 15% minimum tax on worldwide corporate income. This seems to be gaining the most traction, although it could range anywhere in the table above from 18 to 26%, 26.5%. So take note that this is one possibility, but as of today, nothing is formalized. Some other major changes that may impact individuals more directly would be that the top tax rate goes from 37% to 39.6%. And if you include the net investment income tax of 3.8%, you end up with 43.4% for the top tax rate. They also would like to extend the child tax credit. So currently it's $3,000 per child for those under age 17. And then even a little bit more for those that are younger, under the age of 5. But they're looking to extend the child tax credit through some of the spending packages. Also to make some changes to long-term capital gains rates. Currently, the top rate does peak at about 23.8%, but they're looking to make that even higher. We'll address this in the next slide. So if you look at this table, on the left-hand column, or left-hand in the gray, is filing joint or being married, filing joint. And you can see within this chart, the left-hand side is the current 2021 tax brackets. And in these brackets, what has been proposed is that the brackets do not change for tax filers under $400,000. But what you can see is at the $400,000 level, then it goes to the top rate of 39.6%. This is still a proposal, and so nothing has been changed, but this was something that was passed around. Obviously, if we remember a couple of slides back, we had tax revenue and tax outlays. So we have to increase revenue if we want to have more outlays, because over time, deficits can cause economic troubles. This slide here looks at current capital gains rate and proposed tax rates under the 2022 fiscal spending package. They've made proposals to keep capital gains rates the same up to $1 million. And then at that point, for over $1 million, capital gains rates would go to the highest federal marginal bracket proposed, which was 39.6 plus the 3.8% Medicare surtax, ultimately giving you a 43.4% top long-term capital gain tax rate. And this was proposed for those making over $1 million. And we'll have to see what comes of that. One other item that's been of late has been the wealth tax for those few billionaires. This is not yet in this. This is not in the slides, but it's something that came after the fact, and so we all have to wait and see ultimately what comes to fruition. Now we're going to look at planning ideas and how to strategize given the certain tax rate that you're in. So 3 buckets we can consider would be tax me now, tax me later, or tax me never. So tax me now would be if you're in the lowest brackets, the 10 or the 12%. The idea being if tax rates are to increase in the future, we want to take advantage of low rates as we can. So if you're in the 10 or 12% bracket, you could sell long-term capital assets and pay 0 long-term capital gain rate. This is a great planning strategy if you have the ability to sell something for a gain and pay no tax. One thing would be also Roth conversions or loss harvesting. So tax me later is general tax deferral strategies. So those that are working, it would be contributing to a 401k, taking advantage of tax deferral opportunities that are there. And then tax me never. This would be if you're in the highest tax brackets. You want to look for every opportunity to never pay tax on certain items of income. One thing would be health savings accounts. You can fund the health savings account for those that are younger than 65 and are eligible to contribute. And if you use those funds for healthcare purposes, you don't pay tax on any of the earnings. Some of the other items would be qualified charitable distributions or gifting income producing assets to those in lower tax brackets. One thing to mention is in 2020, IRA required minimum distributions were not required. Now in 2021, IRA distributions are required. So we need to think about how we strategize with that. So in doing your IRA required distribution, you must first fully satisfy your required minimum distribution, and then you can convert any additional funds from an IRA to a Roth IRA. So some things to consider in doing this is that we have historically low tax rates. If we think rates will rise in the future, isn't it a good idea to take advantage of low rates now and convert ordinary income upon distribution, IRA money, to Roth IRA money, which is tax-free? So there's no income limits on conversion, but you must first take your RMD. If this is a strategy you'd like to discuss further, please let us know and we can run some analytics to show the advantages and disadvantages in your particular situation. So now we're going to take a glance at general checklist. There are various strategies represented in these slides, and I won't go over them all, but I want to have available these checklists so that you can think about your tax planning strategies. Ultimately, the goal is to reduce income tax in today's terms and to delay it to the future, and if possible, avoid taxation by using wise tax planning strategies. So one thing here on this slide is charitable planning. So now, if you're age 70 and a half, you can take money from your IRA and send it directly to a charity. Age 72 is your required minimum distribution age and having to take money out of your IRA. So starting at 70 and a half, you can consider sending money from your IRA directly to a charitable organization. That limit is capped at $100,000 a year, but it's one opportunity if you're charitably inclined to move money from your IRA, which is ordinary income upon distribution, to a charitable organization, and there's no tax on that distribution. One advantage is that it can help lower the taxation on your Social Security and also allow your bracket in general to be reduced, which can afford you other tax planning opportunities. So when we think about tax planning in general, always be reminded of significant financial events. Do you have stock options at work? Did you sell a rental property? Do you have a job change? Are you retiring? Or are there just things that are occurring in your family that need to be considered? So please reach out to us if any of these items cause questions for you and you're uncertain on how to move forward. We can be reached at the various email addresses, or you can call our office at 919-782-9689. Thank you for joining me today. I hope this was helpful and informal. And if any additional questions come up, please contact us. Thank you. Have a great day.